Income, credit, equity. Those are the three things that really determine whether you qualify and what you qualify for. Now you're trying to say, I need you to make a payment of $3,000. At the end of the day, common sense beats everything in life, and you have to think about it. But we're talking about terms and what they mean to qualifying right now. So by doing that, some countries you have to put down 30 to 50% to buy a house.
Right.
And get an 18% interest rate. Half the loan officers don't even know what's going on the market because they're just trying to sell some junk to somebody. All right, guys, today we're going to talk about the basics. Mortgage 101. Most people probably know about this. Some people don't know about it. Sometimes you just need a refresher. But we want to just kind of go over the basics here. And then we can go in depth further in other episodes and other things that we do. But let's get the basics out of the way.
Let's get a little overview of the basics, back to basics.
Yeah, back to basics, baby. We've got the laptop so we can remember notes because we're always trying to remember what we went over prior.
Can't see too far. So this helps out. So
yes,
it'll help us keep us on track for our off-topic info. So
we're going to try and stay on topic today.
How about
that? Let's do it.
Let's do it. So intro to mortgage. Let's go over some of the terms. We got DTI, LTV. Those are the big ones, right? When people are trying to qualify. Yeah. Let's go over it.
I think start there, right? It's a lot of us know it, like I said, but what does it really mean? And if you don't know it, it's everywhere. So whether it's here, Google, you use the most advanced assistant that you have called Google and look it up. But let's start with, like I said, debt to income ratio, right? DTI, debt to income ratio. It's one of the major three things that is going to be what you qualify on, right? So I'm going to take a step back actually and say, like, we used to have the acronym ICE. I'm not sure if you've heard that one or not, but it was income, credit, equity. Those are the three things that really determine whether you qualify and what you qualify for.
Right.
And the I of income is really the debt to income ratio, right? So it's saying, here's my income and here's my debt. And what's that percentage in between that I qualify for? Most lenders, typically they go up to 50% or 45%. There's two ways that you're looking at it too. You're looking at the front end debt ratio and a back end ratio. And what that means is a front end ratio is a housing expense, right? So my mortgage is 1,000 and my income is 2,000 and my debt ratio is 50%. And then there's the back end debt to income ratio, which is all of your debt.
All the other stuff.
Yeah. Again, not when qualifying for a loan, nobody cares about your utility bills, your gas bill, any of that stuff. We're looking at what is actually reported on credit, like credit cards, student loans, car loans, personal loans, and other mortgages.
Yeah. School's been a big thing too as well, right? And that, so that's another one to count.
Yeah. Yeah, exactly. So like as an example, the simplest example I could think of is you have a mortgage that costs you $1,000 a month. We all wish we could do that these days. But let's pretend it's like 1982. You got a mortgage at $1,000. You got credit cards and auto loans and everything else. Those all equal $1,000. So altogether you have $2,000 of debt. You make $4,000. That means your housing expense, that front end ratio at 1,000 is 25%. And your total debt ratio or back end debt ratio, debt to income ratio, is at 50%. 1,000 plus 1,000. It's half of 4,000, right?
Right.
So in that case, somebody would say your debt ratio is 25 over, right?
Yeah. I mean, as a bank, you want to make sure someone qualifies. That's why they have those rules set in place. You want to make sure those people that you're borrowing money to can pay this and afford it. That's the point of it, right?
Yeah. I mean, with loans or life in general, but I tell clients this too, like put yourself on the other side, right? Would you lend us money to somebody who doesn't qualify? Would you lend money to somebody who has nothing to cover it back in case the worst happens? Would you lend money to somebody who has bad credit because they don't pay their bills?
Who missed 3 credit card payments this last year? Like what?
You're right, exactly. Which are minimum payments of $50. Now you're trying to say, I need you to make a payment of $3,000. Can you do that one? So at the end of the day, common sense beats everything in life, and you have to think about it. But we're talking about terms and what they mean to qualifying right now. So.
Right. Well, yeah. I mean, you drew it up very simple and easy to understand. A lot of people still don't understand that aspect and think, well, why can't I get this? But yeah, you can't afford it.
Yeah. And you have to find your comfort zone as well. I think a lot of people like push to the max, but again, maybe you have stuff out. Maybe you have $2,000 a month in expenses that are not going to be on credit or part of a mortgage. Maybe it's, again, daycare, childcare, again, gas, food, utilities, all that other stuff that somebody qualifying for a loan is not going to know. So make sure when you're talking to your loan officer or you're doing it yourself, look at your finances, which I advise against. Talk to a professional to help you get guidance. But make sure that all matches up. Like you don't want to go 50-50 in my example of $4,000 a month, right? And $2,000 goes to bills. But what if you have $500 to childcare and $1,000 to food and you got all that stuff? You don't want to make yourself skinny and push to the max if it doesn't fit into your lifestyle or your personal budget.
What if your garbage disposal breaks? You need a new one. What if whatever?
Yeah, that's a whole nother topic of breaking down and diversifying where funds go to for short-term, long finances, emergency funds, all that kind of stuff too, I think. But yeah, you have to think about all that stuff too. So just because you qualify for something doesn't mean you should get it. Right. And that's something you should really look at with somebody who.
That's a hard thing for people to, I've seen that a lot and I can afford it, but they push that limit and 6 months later, they're like, I need to do something about this. I can't do this.
Everybody can afford something till they can't, right? So, and, we all think one thing and like you said, the garbage was breaks and you're like, I didn't plan for that. Hence, on another topic, we'll go into emergency funds and why you should have money put away for certain things. Right. So, or I call it the war chest, or whatever you want to call it.
Yeah. Well, I'd like to get us back. Let's just back it up. Actually, what is a mortgage? I want to kind of let's get back to that because I think people know mortgage. They hear mortgage. I have a mortgage. I want a mortgage. Whatever. What is a mortgage? We need to go over that.
In California, we don't really have a mortgage or a promissory note, right? But I mean, what is a mortgage? And to me, it's how you leverage debt, basically. Like I can't afford it's a credit card, borrowed money, whatever you want to call it. But it can actually be a good debt depending on how you use it. You're borrowing money from somebody, a bank typically, right? Or it could be a private money person or a group of people in a portfolio, whatever. But let's just talk what most of us know about traditional loans, right? You borrow money from a bank. They have rules to get that money. You're borrowing that money, this little chunk of money to go get something bigger that you want, that whether it's you live in or it's an investment or your family, right? So you're leveraging your good credit and your income for somebody to give you money so you can have something you need or want.
Right.
And to me, that's what it is. I mean, I know there's like the actual definition. I don't know how to read, so that I don't know what that would actually be, but I think of it as a leverage. It's a tool because in some countries, like here, you can get a house with 3.5%, 5% down, 0%, depending on what it is. Right. And actually get into a house and you're leveraging whatever it is that the program is allowing, your income, your credit, your no equity pretty much, but you can get into a house by doing that. Some countries you have to put down 30 to 50% to buy a house and get an 18% interest rate. And that's because they're just not as lenient on that stuff. Right. So yeah, and again, taking advantage of it is great, but you leverage a mortgage. Well, you can leverage a mortgage. Like I said, whether it's a good debt or bad debt. If you're buying your primary home or your first time home buyer or whatever like that, you're basically trading out in somebody else's mortgage to pay your own mortgage. Right? It's like having control of it. So,
right. Well, yeah, most people don't have $400,000, $500,000, $600,000 to buy a house. So they have to borrow from somebody. But yeah, like you said, your credit, your income is showing proof that you have, a good standing to where you can afford a payment to pay the bank, which gives you why are they giving you money? Because you're using your house as collateral, basically, right? It has value. So you're borrowing against it. So yeah, I mean, that's what it is. Basically, you're borrowing against the house value. You're putting some money down, have the rest to pay off, but nobody has that much money to put, and buy a house straight out. So that's why people have mortgages and borrow money from banks. So,
right.
Yeah. I mean, it's as simple as that. Like you said, instead of renting, you're borrowing from a bank and being in control of your rent by paying your mortgage there. And taking charge of that. So,
yeah, I think exactly. Yeah. Leveraging your equity or whatever it is, your qualifications to get something you want, which is great because I'd rather have control. I'd rather punch a hole in my own wall and I don't care if I want to fix it or not. I can,
right?
Than punch a hole in somebody else's wall.
Right.
No, I have to fix it or pay up.
Right.
But yeah. So,
okay.
Mortgage. There you go. I guess that's good enough. We're not trying to be perfect. We're just trying to be good enough.
Good enough. Yeah. No, I'm just that was a very simple explanation. It makes sense. Yeah, it is what it is. Types of mortgages. There's different types. Typically, there's a 30-year fixed is your average one now, but there's other programs and this and that. But
yeah. And most of everybody knows this stuff. Again, we're going to repeat it. Maybe 20 or 30 years ago, not as many people knew it, but now you get the power of the internet. So everybody thinks they're a pro at everything, right? You watch a few YouTube videos, you do a couple Google searches and you're a pro, but let's just go down that list. Traditional loan. A traditional mortgage is a 30-year fixed. End of story.
Right.
A 15, a 10-year, a 25-year fixed, an adjustable, whatever. Those are all non-traditional loans.
Right.
At the end of the day. But, we kind of think anything fixed is a traditional type of loan, or
typically, right.
Conventional fixed is a traditional loan. So yeah, 30-year fixed is a traditional loan, which is most people have, which is very lenient. There's people that do 40-year loans. There's people that do 10-year loans and everything in between. So, but yeah, you have multiple different types. So term wise, I don't even want to go too much into it because everybody wants to do something different. Again, you 10, 15, 20, 25 government loans, 26, 27, 28-year terms. I mean, weird investors for lenders for like investors and private money, can do 40, 50 years, right? There's no really rule to it, but let's just say you could do that on the term that fits your budget and what your actual goal is, because you want to talk about that. The types of loans you have, we all mostly know conventional, right? Which is Fannie Mae, Freddie Mac. That's what everybody likes and thinks is better, which isn't always the case, right? But yeah, you got your Fannie, Freddie, so your conventional loans, you have your government type loans, which is FHA. So typically conventional has always been known. Let me jump back to conventional because conventional has always been known like the better borrower, right? Better credit, bigger down payment,
a better ratio, like we talked about with that debt to income ratio.
Right.
Like all those things to qualify for those.
Yeah. So the ratios there can, 45%, 50% sometimes, but they used to be like 42, 41%, whatever it was, where FHA will allow you to go like 46 to 56, right? So you could have a worse debt ratio. But yeah, so conventional has always been known as like the good borrower, the prime, A+ paper, right?
Right.
Where FHA, USDA, VA, they have different benefits, but they're government loans. So they allow people with less down payment, worse credit, higher debt ratios, right? Because they're insured by the government,
by the Govy.
So, yeah, but that's not always the case. So like I said, when you talk to whoever you're talking to, hopefully a knowledgeable loan officer that's guiding you through it, they find out what's actually best for you.
Not just somebody trying to complete a loan for you.
Yeah. You don't want to talk to somebody who like doesn't know what they're doing. They got in the business 3 weeks ago because their, cousins needs a loan and they want to do the loan for them to make a few bucks. But
a great example of what you're talking about is this last year, right? It was always thought conventional was the better loan, stronger borrower, better rate, no mortgage insurance, all those other things that we're going to go over. But FHA actually was so much lower rate. It was a much lower rate for a good part of this last year compared to conventional. It didn't even make sense for most people to even do a conventional loan. It was almost better for a lot of borrowers, right?
Yeah.
Depending on the scenario, all those things, right?
Even if you have a 800 credit score, it was still better.
It was still better with the 800 credit score, which goes against, you're not going to Google that and figure that out, right? You got to talk to somebody that's in the business. So that great example of that. Yeah. So.
Yeah, I think with any of these, like you said, be knowledgeable. Outside of that, I mean, you have again, like the government loans are USDA, which is typically, let me break that down really quick. FHA, most people know about FHA, but it's a government loan. You pay mortgage insurance because it's insured. You have a little down payment. You can do down payment assistance programs with it. And the rates are typically better because you have mortgage insurance, because there's additional costs that go into it. And because you might not be as well of a qualified borrower, like we just talked about.
Yeah, those were made basically for people with lower credit, not as much income. They weren't as, qualified as a conventional. So that was created, right? Just to let those kind of people get into houses basically and buy a home.
Pretty much, yeah. To boost the economy so more people could buy houses. Because more people that buy houses, the more people that pay taxes, right? More people that pay taxes. They bring commerce to cities because now they're living there. Now there's schools. Now there's water filtration systems and dumps and whatever else, right? Fire departments and everything else. That's just the economics of city growth, of how how a city grows from where it becomes a town, or, oh my gosh, I can't think of an unincorporated town. Yeah. The infrastructure of a city, right? But
to build it up. Yeah.
Yeah. So that's why they were created. VA, veterans military, has VA benefits.
Right.
those are great loans. You can go up to 100% finance. You can actually go over 100% financing when you roll in the cost or the funding fees that they charge you or whatever. But it's a government loan like FHA. So it allows 0% down and it allows a little easier guidelines, but you have to be a veteran for that. And then USDA, which is always a fun one because most people are like USDA, farm, agriculture,
right.
But it really is not. It's low income.
Right.
Housing. So
it's low income, but it's not too high of income. We found out that it's a very small criteria to fit into that. And it's in more areas than you think. Actually, where I live right now, which you would think city, this and that, but it actually is in a USDA zone as far as zip code and area. So it's in a lot more places that you think, but it's a very small criteria to qualify for those loans, which if you can, I would look at it. Why not? And you can do 100% financing on those, right?
You can do 100% financing on that as well.
Yep.
But like I said, you nailed it. It's a tiny box. You can't make too much, but you have to make enough to be having those debt ratios that we talked about be actually lower. Do you remember what they are? Like 38, 33?
It's 38 over 43. It's just a small box. You have to make a certain amount to qualify, but you can't make too much because then you won't qualify because you're making too much and you need to go to another program.
They're going to look at the AMI, right? The average median income of wherever you're buying at, and then take a percentage of it. So again, I don't know all the underwriting guidelines, but yeah, like I said, so if you make over a certain amount, you don't qualify. If you make too low of money and your debt ratio is too high, you don't qualify. So
it's a lot. Yeah. We've done a few of them here, but it's kind of a pain, but I would check into it. It's worth looking at actually, but,
yeah, I know you've done a few of those. So
yeah, it's frustrating at times because you're like, this guy fits in this box, but then underwriting does something and then it's no longer qualified. So let's go somewhere else. But
right.
That's how it goes.
So yeah. So outside of that, you have jumbo loans, which is for your killers, your money makers. You have big down payments.
The big boys.
Going back to like, why would you do a jumbo over conventional? Well, because conventional and government loans have loan limits. They don't allow you to finance over a certain amount of money. Right. So if you're buying $1 million house, but the conventional loan limit is, I don't know what they are now, 750 something, yeah. Whatever it is, you either have to put 250,000 down or you have to do a jumbo loan, right? Because you're going to go over what those loan limits are. So every city or every county is a little different. There's like your standard, and then some counties actually have to be higher. Like in LA, I think it's over $1 million.
LA,
but the average house is like $1.5 million.
So that's because it's a high cost area. Exactly.
Right. So yeah, you go into a jumbo, but jumbos do require a bigger down payment. So in that example, let's just say it's 750, and you're trying to buy is the max conventional loan limit. You're trying to buy a house that's $1 million. You would need 250 down, but you don't have that. Say you only have 200,000. Well, you'd probably be looking at a jumbo loan because you need an $800,000 loan to do that, which would allow it for a jumbo.
Right.
And they're a little tighter though on their guidelines, I think.
Right. A little higher interest rate.
85 to 90%, or 10 to 15 on some of them.
It's constantly changing, and some banks kind of change their criteria on that. So I've seen 80, 85, I think was the best I've seen it recently. Mm-hmm. But I think we saw a 90.
I think we did see somebody putting out 90s out there.
But it's everything's changing, rapidly. So it's always changing. But are those rates are usually higher, right? Just because you're borrowing more money.
Right. Anytime you're over 80%, I don't care if it's jumbo or conventional or whatever, you have a risk to the lender, or the lender has a risk, I guess, in financing you. So they're going to have what they call mortgage insurance. And that mortgage insurance is not for you. That's to protect the lender themselves because you don't have much skin in the game.
That's a common mistake I think people think of as mortgage insurance. Yeah. That's my insurance in my house.
No. That's to protect the lender in case you don't pay them.
Right. That's where it goes back to what you said originally is think of yourself as the lender. Think of yourself as the bank. Why would I want to borrow to you? Am I going to impose these insurances to safeguard myself? Yes, that's what the bank does.
Most people do this. Like, oh, why would I need that? If I don't pay, they're just going to get my house. I'm like, you think somebody wants your house that you probably thrashed because you didn't make your payments or care about it?
Right.
And that they have to maintain and manage and pay taxes and insurance and all this stuff on? No. The reason that 20% rule is there, of having 20% equity or 20% down or getting to 20% not having mortgage insurance, is because that's roughly what it's going to cost to get rid of your home, whether it's to fix it up and sell it, attorney fees for foreclosures, and all that other stuff that goes along with it, servicing. So that's how that number is there, which isn't bad. Like I said, you can tell the risk is high or low on defaults by the amount of mortgage insurance being charged, right? So it's probably low because FHA just lowered it.
Right.
which is great. So if you did a loan, prior to March of last year on a government loan, FHA loan, call your loan officer because you might be getting lower mortgage insurance. They lowered it by 30 basis points, which is 0.3%. So that could be a big chunk depending on the size of the home you have.
And depending when you bought, rates have gone down since then. So you might be dropping your whole 1% or more. So
yeah. So, I mean, I think it's good. Like for this kind of stuff, nobody's expected to know it all. Half the loan officers don't even know what's going on the market because they're just trying to sell some junk to somebody. But you should be talking to whoever your financial advisor is or loan officer or expert that helps you with this stuff at least once a year because things change all the time. Like they're always changing.
Right.
Programs come out. Mortgage insurance goes down. Mortgage insurance goes up. We always just look at rates, right? Everybody's like, oh, what are the rates doing? Right. But there's more things. Who cares if the rates went down to 1%? The program might not be there. Maybe it requires 80% down. It's not going to be beneficial for you anyways. But
right. Yeah, there's always more to the story. So yeah, make sure you inquire and ask questions because it's not always cut and dry or what it was 3 years ago even.
Yeah, exactly. So I think that's important. So yeah, jumbos are there. Again, if you do 85 or 90% jumbo, you are going to have a bigger rate. They don't typically charge mortgage insurance. It's typically built into the loan. So it is higher, but that's where you and your professional or your financial advisor would go through and say, is that worth it? Right? Because I'm leveraging it. So what if I'm paying a little bit of this? If I pay $10,000 a year on a jumbo, for example, in mortgage insurance, but it appreciates $30,000. I gladly give $10,000 for $30,000 anytime. So,
right.
But again, people are greedy. People think on the layer sometimes, and we just are like, I ain't going to pay that shit. I'd rather not have a house or whatever the case is. So we see that all the after that, you have like non-QM, non-qualified, which are typically for self-employed people or investors, right? It's your income doesn't look right on taxes. So we look at bank statements instead, right? Like if you're a business owner or you're buying an investment property, but you don't have the income to show. So you're basically basing it off of what that investment property produces on income. Like, for example, it makes $2,000 a month in rent. My mortgage payment is $1,500 for principal, interest, tax, and insurance. Boom, you got a loan. Basically the debt service is the payment. So that's what they're looking for on that.
Right.
It's called DSCR. I forget what it stands for. Debt service something. Yeah.
The C and the R.
I forget.
Yeah. What's the debt service consolidation ratio?
You have the computer. You should look it up.
Let's look it up right over here.
Debt service. Yeah.
So
ratio.
That's a good thing about that type of loan, but is there a higher rate? What kind of?
Yeah. Rates are typically higher. So again, just like we talked about earlier, put yourself in the other person's shoes. Everything's based off of risk, right? When you get insurance, if you've gone to the doctor, say car insurance, you've gotten in 5 different crashes, your insurance is going to be higher or they won't insure you. Right.
Right.
And loans are the same thing. You can't show your income, but we trust that it's going to be there, but there's a little more risk. We're going to give you a little higher rate to cover.
You're a riskier loan. It actually stands for debt service coverage ratio.
That's what
coverage.
Magic.
So you're covering the mortgage payment with the rent.
Right. You're debt servicing it basically, coverage rent.
Right. So yeah, I get that all the time. And people think they can get this loan and they see 5.99, this and that. No, you're a much riskier loan. We're not counting income. We're not looking at taxes. We're not looking at any of that stuff. Why would you borrow somebody that's showing you nothing when you have someone over here that's showing you pay stubs, W-2s and everything, showing all that to buy a house. So yeah, it's going to be a higher rate. So
it's going to be higher. And again, if you're an actual investor getting DSCR loans, then you probably don't really care about the rate. You care about the cash flow that's coming in from the property.
Right.
Like I don't care if I'm paying a 20% interest rate. Does it get me the money I need to buy this thing that actually has cash flow?
Right.
That's all I care about. Again, probably in your primary home or the average consumer probably thinks a little differently. They're like, what do I see on the internet? My friends tell me.
Yeah.
I have people, friends are like, my friend told me they got a 5.5. Well, your friend got an FHA loan with 0.85 mortgage insurance and paid 3 points to get to that.
Right.
Do you want to do that? Then we can do that. you qualify for something different or you're trying to do something different. So there's all those different scenarios, but yeah, every loan out there basically has a purpose. Even back in the 2008 era with the negative amortized loans, they were good if somebody utilized them the right way. The problem with bad advice and bad people in an industry or bad thinking, is that people get the wrong loan for the wrong purpose sometimes.
Right.
Like I went like adjustable loans as well. Adjustable loans are not bad. They're not really beneficial right now because they're not improved much. But when we were doing them and the rates were like a 1 or 2% lower, it was a good loan to have for, say, an investor or somebody who has a high income that could accept that risk for that benefit of that lower interest rate. But heck, you wouldn't ever give that to somebody like grandma who's on a fixed income. Like that wouldn't make any sense. Or somebody who's pushing the ratios, somebody with $1 million in the bank and they have a high income and their debt ratio is super low. And they're like, yeah, I can take that risk.
I can take this rate changing in 2 years, 3 years, 5 years, whatever.
Exactly. So those loans had a purpose, but again, you give the wrong person the wrong loan, it gets a bad rep and nobody wants to do it.
Right.
It pops up on Instagram and Facebook and, we got a whole other conspiracy theory going on.
TikTok.
So those are the main ones that you'll see out there, which is the conventional government loans like FHA, VA, USDA, non-QM loans, jumbo loans. You talk to the right people, there's other stuff out there. I mean, commercial loans, SBA loans, private money loans, right? And they all require something different. They're all going to be a little different. So if you're looking at anything outside the box, you just, again, talk to a professional, talk to somebody who knows what they're talking about, because there's always a way to find money, especially if you have collateral or something to leverage it with.
Right. Yeah. Yeah. All right.
That was my winded version.
Long-winded?
Long-winded.
What about interest rates? Let's understand some of the interest rates and why are they changing? Why are they so high? Why were they so low?
Why are they so high? They're not high. Yeah. What are we talking about? I mean, that's market changes. I don't even know what to say about this.
Right.
Market changes. It was not healthy when it was super low. We take advantage of it. We loved it being super low, but for an economy, it wasn't really healthy. I mean, inflation's not going, if everything's supposed to go like this, and then for a few years it stops, it's going to jump up and has to balance out. Right now we're in a balancing act. So all indicators point that those will come down in 2024, but do we know or care? No, we go to war. Job loss can be high, we're having more job losses or something in the economy that is catastrophic could happen that changes it all. But typically the rates are just moving based off of the economy and what's going on with our friends in Wall Street. Who's buying what, who's selling. The reason I don't even know the reason why they're low, to be honest. You probably know more about that maybe. Oh my gosh. I guess I didn't turn that thing off. You guys are going to have to listen to a phone if you could even hear it. I don't even know if you can hear it from here. Probably.
Maybe. Yeah. Hopefully we don't have another COVID. That might do it again, but
yeah, I mean, exactly. I forgot about COVID already, man. How long has it been?
What was that? 2020, late 19,
4 years
2020. But yeah, I mean, that happened. Everybody got locked in. The economy stopped. So they tried to stimulate it, brought down the rates.
And it was also coming out of, 2010, 11, 12, even coming out of the 2007 and 8 bubble crisis, right? So there was a lot of things implemented, like having a higher debt ratio to get a loan to help stimulate the economy, to get people buying again.
Right.
But again, that happens every 8 to 15 years, I guess, on average.
It's cyclical, right? It happens. It goes.
Yeah. Right now, that's what you're going to see happening. They're going to probably drop rates, not only because they should and they need to, but they also need to not get themselves in too bad of a hole. It's like, again, it's a balancing act like everything in life, but if they need to lower it to get people to buy again, because again, people buy, it increases the economy. It stimulates what's going on in cities and towns and states and everything else. So, I mean, personally, I think the average rate should be like 5 to 6%. That seems healthy to me.
Well, I just bought at 6.99 and I disagree. I think 1% is better.
Yeah.
But I think it's going to.
Don't get me wrong, by the way. I want it to be as low as possible personally, but.
Just for me.
Yeah, just for me. Yeah. Like go down to 1%, then we could buy everything. And then when it goes to 10%, we'll just stop buying everything.
Right. Yeah. I mean, during those couple of years that there were 1%, 2%, 3%, everybody did something, right? They were moving. Everybody took money out of their house. Everybody's equity went up crazy that time. So everybody had just money. They bought boats. They bought this. So the economy got stimulated, but that's what inflation just happened this last few years. And the
economy got stimulated. The U.S. debt doubled, tripled, whatever.
Everybody started taking money out of their house, borrowing, going.
Because they got all that free money that we're going to end up paying back some way, somewhere.
Right? Yeah. So I don't know. But yeah, interest rates, they're going to fluctuate,
It takes little things that make that interest rate move, right? Like a job report. It's up a little bit today, I think, right? But that was just because of a report. If people are buying or, selling off their mortgage-backed securities, the people that actually hold the mortgage notes, if you will, on Wall Street, because they think something bad's going to happen, that's going to cause a reaction.
They sell them off.
Right. Or they're buying more, or the government's buying more instead of actual corporations or individuals. So those are all things that can change it. But ultimately, if you track charts really good and you're into that kind of thing, you can kind of get an idea what's happening. And again, we know right now they look like they're going down. So for the year, which is good, but don't hold your breath. So we thought in 2021, we thought that was the end of COVID, and we are expecting rates to go up, and they did for like 2 to 4 weeks. And then it was an even better year. So it came back down and, and things was all good and gravy, and everybody was living life.
The third strain came out and turned it back around. So,
well, don't we have another strain right now? So I heard it's even more important, but it's just not relevant for the news. So
yeah, well,
who knows?
That's a whole nother conspiracy.
Yeah, let's go over that sometime.
But yeah, so that sounds good. Yeah, interest rates, just know that, they are what they are. A lot of things affect them. They're supposed to start balancing out. Hopefully they don't turn the corner too much. I always consider that, like, how the government's been changing these rates too quickly. Like a boat, you're turning one way. If you turn it too fast, you're going to crash the boat. You need to do just small corrections to fix things. So that's why I think it's taking a little while to turn it around right now. But
I love the analogy.
Yeah. Hey,
let's see how many analogies we can get today. That'll be a challenge.
But yeah, they do.
I had bad ones, but yeah.
But they do impact everything. Obviously, the last 2 years have been kind of rough as far as housing because, interest rates went up to 8% rapidly from 3%, right? So people aren't buying. People aren't upsizing their house because they don't want to lose the 3% rate they got 2 years ago. They don't want to sell their house even and move because of their job, because they're going to lose that 3% to an 8%. Like all those things were impacting everything.
Which makes sense. I don't want to get rid of one I have either, but that doesn't mean I'm going to stop living because things are going to move on and change. And by the way, at the end of the day too, it's good to know that the rates are justified by this stuff we're talking about, that the things that happen in the market and whatnot. It's not like some magic person is like going to be giving you a 2% while everybody else is giving you a 7%, right? That's just not going to happen. So some people are shopping all over the place for that kind of stuff. But at the end of the day, I mean, they might be off a little bit, but a little adjustments here, but somebody who's good will know where to find you the best placement. So,
right. Yeah.
And that's going to happen no matter if it's like 1980 or if it's 2020, or it's like right now, the beginning of 2024, we're all shopping at Amazon. We're all digging out the same box.
There's no count from Sesame Street every morning going 1, 2, 7.
Yeah, I know. I personally have had clients where I'm offering, and this is my fault, but I'm going over what I think is best for them. Maybe it's a short-term plan because of what they're trying to do. And then they ghost me. They go to somebody else. They get a half a point lower. They paid 2 points for it. They paid $10,000. But there's somebody offered it to them, which again, my error. That's something where you have to let me not try to help you. Let me just show you so you could, I guess, help yourself. But yeah, so it could be just somebody's telling you something different. Again, we're shopping out of the same box, the same store, but they just gave, the brand name toothpaste versus the other toothpaste or whatever. Bad analogy. You got some bad ones.
Let's go. I always use this analogy and it made me think gas stations. Gas is usually typically within a certain range, right? Mm-hmm. Some Arco down the street has a certain price, but Texaco up the street has 10 cents more or whatever. And so-and-so's down the street is 5% or 5 cents more. I mean, you're shopping around. It's all the same. Somebody's going to be better in 1 week or the other. That's what it is. It's just everybody's adjusting prices as, accordingly. So sometimes shopping and going, how you drive that extra 10 miles to save 3 cents, but it actually costs you more because you're driving.
I hate that.
Yeah. So
there are people that do that.
A lot of people do that in mortgage. They'll shop around to 5 companies, but by the time they get to the 5th company, option number 2 was way better and they missed it. So.
Are you the person that gets gas and then moves on with their life to get stuff done? Or are you the person that goes and waits at Costco for 3 hours to save $1?
I'll save a Costco. Costco sometimes is good I have not a busy Costco by me. So that's
okay. If you're the Costco by me, you're waiting there like an hour.
That one sucks. I know which one you're talking about. So.
Yeah. So yeah, anyways, like I said, good to know, like no magic sauce out there, guys. There's no magic sauce with most anything. Just people do things better than other people. That's all it is.
Yeah. So, let's go over another portion of that mortgage that we're talking about.
Yeah. What's next? What are we talking about?
Let's go over the jargon. What's within a mortgage? We have your principal.
Ooh, we're jumping.
Interest.
Yeah, we started, but then we had a topic.
Well, that tends to happen around here.
Yeah. So go through that list again. I cut you off.
So your typical mortgage, right? You have the principal and interest. That's based off just the loan itself that you borrowed the money from, right?
Right.
So depending on that interest rate we just talked about, you're paying a certain principal.
And your payment is only determined by three things, by the way, guys. It's the loan amount, the term, and the interest rate.
Right.
That's it. That's your principal and interest.
How much you borrowed, how long you have to pay it, and the interest rate, right?
Right.
So,
and that's all it is. There's no like, I want this $1 million home for $1,000 a month. It's just that physically, literally does not happen because there's no math that makes that.
Unless they start making 100-year loans.
Maybe 500-year loans for that. But yeah. So again, be smart. If you're doing it, use a calculator, use one of the 1 million calculators online, or just ask your professional and find out what those realistic numbers are. And I can tell you right now what a payment is if it's at 0% interest or 15% interest based off those other two factors.
Right. That all goes into that principal and interest. You're paying a certain amount of principal, paying back the loan, and you're paying that interest on what you borrowed, basically back to the bank for borrowing that money in the first place. The two other parts of that is taxes and insurance that people don't think about when they buy a house. And
HOA. I put that all in the housing expense.
Yeah, we're going to go to HOA, but tax and insurance, everybody has. A lot of people now have HOAs in these communities, condo for sure, townhomes, yes. But everybody almost has an HOA nowadays, depending on where you live. But yeah, renting, you're only paying your rent. A lot of people that I've talked to, they buy a house and they don't incorporate taxes, insurance, HOA into the monthly payment bills. And that's why we have that debt to income ratio. That helps you incorporate that to see if you can afford a house. But I always find people, they don't factor in taxes, insurance, and HOA. Always.
Yeah. And you have to. I mean, emergency funds, knowing the whole, I guess people, like, if you're an analytical person, you probably love drilling down deep into this stuff. But yeah, you got to look at taxes. What are my taxes? I don't know. Depends on where you live, right?
It all depends on what county, loan size.
Yeah, you have to know where you're at. You have to know what's around you. Like here in California, the typical rate is like 1.25%, right? But if you bought something that built in the last 20 years or whatever, then you probably have higher taxes. Some people are at 1.8, 1.9. How hard is that to do? It's not. You hop on a website, the county website for wherever you're at, and you pull up a property tax bill.
Right.
So when you buy a house, that 1.25% or 1.8 or whatever it is, and by the way, those differences are, supplemental taxes. They might be like taxes for 30 or 40 years for a water treatment facility, right? And then they fall off and you go back to your, 1.2.
They do change, but they typically going up all the time. It's not always they come down.
Because they are based off what your home is worth, right? You're paying tax on so when you buy a house in California, that 1.25% we'll use is based off that purchase price. Now, if your value goes down, you can always fight to lower your taxes. And as it goes up, your taxes will go up too, right? Some states don't. They have weird formulas. I think Nevada is like, it's not off the purchase price. It's like 2% above the previous assessed price or something like that.
Yeah, everybody has
Arizona's like 0.85, I think, tax rate. Texas is like 500% in tax rate, something like that.
Well, regardless, I mean, everybody has their different rules and formulas and this and that. But just for my instance, I pay $1,000 for taxes, insurance, and HOA on top of the mortgage.
Right.
So yeah, if you never thought about that and you're going into buying a house and you think, oh, my payment's going to be this, and then you walk into all this extra stuff. Yeah, a lot of people are not equipped and ready for that. So make sure you guys think of that when, you're buying or whatever.
Yeah. So things to do is figure out your principal and interest if you are buying. Again, I don't care if it's now or 10 years from now. Figure out that principal and interest. Look at the website or ask your realtor or loan officer to look it up for you. Find out what the tax rate is so you can get an idea what that is, and call an insurance agent for a quote.
Yeah, that's free.
If you can do those things, which probably take a few minutes, you will be able to get a better idea of what your total house payment looks like.
Right. Yeah. No, I think that's important because I find that all the time. People go from renting to buying and they don't factor in those things. And it's a deal breaker sometimes for people that I can't buy.
Yeah, so, I did the math. The payment's only $2,000. Way better than renting. And I'm like,
actually $2,750.
Yeah. You're going to go up a little bit than what you pay rent, but you will own it. We got to find out if it's better.
And that's why, again, you should talk to somebody. They'll figure out, is this better for you, or you should wait another year to rent and then buy later. So
yeah, exactly. That's a good point too, by the way. It's not really part of our conversation right now, but for most people, it's not like going to, Walmart and buying a new pair of slippers, right? It's a planned attack. Like, I'm going to plan for the next 3 months, 6 months, or 12 months. How much do I need to save? How much can I afford? how to get my other debts in order, pay off cars, get rid of student loans, whatever it is to qualify, or just to have the payment or the lifestyle I want to have. Right. So I think big plans, again, I know we keep saying it, but talk to somebody who's going to actually help be with you for that time period. Not somebody who's like, you don't want it right now, click.
Right.
Because there's a lot of those people out there too. You know, you don't want to buy that car right now, later.
Right.
But you want the person that's checking with you weekly. Are we still on track? Are we still doing what we said we're going to do?
With
holding you accountable and whatnot.
With house prices where they're at and interest rates and everything, these payments are high. You need to make a plan, because you're not, like you said, going to Walmart to pick up coffee cake or whatever. It's a plan to tack.
I said slippers. That's why I go to Walmart.
Well, I went to get coffee cake, but yeah, you have to have a plan to tack. Because if you think you're just going to wake up and call somebody, I want a house and I want my mortgage payment $2,500, it's the same as my rent. You need to plan that out, and you need to have a certain down payment. You need to wait for the right time or whatever, off topic and on topic as well. A lot of people are looking for a certain house value or price range that might be out of their price range. I always find that people are always trying to be like the Jeffersons and moving on up.
Yeah.
So a lot of people, I think, have to be moving on back.
Yeah, exactly.
And get back to,
or the people that find the house they want and then put an offer in and then try to go get approved for the loan.
Right.
To find out that they're not the Jeffersons. Yeah. That's
huge common too. So that plan and planning is like, giving the loan officer your financials, get your pre-approval, see how much your payment will be at this price range, and go after something that you actually like and can afford. I see it all the time. People are trying to go way out of the price range and push those ratios like we talked again earlier. So big red flags, make sure you watch those things and prepare. So let's move on to an escrow account. How about that?
What about an escrow account? What is an escrow account?
I'm so glad you asked. So basically what I like to do is simple, you have those taxes and insurances that you pay for your house. That is a new thing from renting, like we just talked about. But, you can have this done in two ways, right? You can pay it monthly. And I always talk about you're putting your taxes and insurance money on layaway monthly until they're due. And then your mortgage company sends them off and pays them. Obviously, you don't have to do that. You can pay them on your own. But most people
sometimes.
Right. Yeah, exactly right. Most people have it done through their monthly payments and put that, laid away until they're due. But you don't have to, right? You can have them excluded from the payment itself and pay them on your own, right?
Right. Well, sometimes. So sometimes if you're not putting a big down payment down, they're going to make you have them in their payment because they want to make sure they're paid. Right.
Right.
Again, flip the table around. If you got somebody who doesn't have a lot of collateral into something, you want to make sure they're paying all their debt. So so usually most people have an escrow account. If you have a low down payment, you have to have an escrow account because you have to make sure taxes and insurance get paid. But I was going to ask you how you explain it. Like you said, layaway plan. And I kind of use something similar. It's like a savings account, if you ask me, right? Whatever. I put a little bit of money in every month. That way I have enough money in there when the taxes are due or when the insurance is due. If I have too much money in there, they're going to refund me money back. If I have not enough money going into it, I'm going to have to pay a little more every month to get it balanced out. But that's the best way to explain it. I mean, I don't know why you wouldn't want an escrow account.
Well, I find it like this, and I explain it to people too. California, you have to pay twice a year for your taxes.
Mm-hmm.
And like I said, I pay $1,000 a month, or I pay $700 a month for my taxes. I don't want to just come out on, a certain date to pay 6 months worth of taxes. I'm not going to afford $4,000 or $5,000 worth of money. Just nobody has that, It takes a real, a great financial person to save that money and put that money away every month. But just have it in your payment, pay it every month. It's taken care of and it gets sent off and you're done. So you don't have to think about it. So that's
out of sight, out of mind, pretty much,
right? And
not have to worry about it.
And that's why.
And then we all get pissed when it's like, it went up $20. What the hell? You know, but that's because your taxes might have went up. Your insurance went up. There wasn't calculated correctly. You weren't putting enough in the savings account, whatever.
Right.
And a lot of people think it's like, it has to be that way. Like you could have money sit in escrow if you wanted to. Like I could like for example, if you get an insurance claim, something happens to your house, right? And insurance sends you money. Typically they put it in an escrow account. They don't just write you a check. Usually they put it in an escrow account so it could actually be applied to what it's supposed to, the roof blew off. Okay. You have $30,000 in your escrow account. You got the claim. That's what is there. It's a place to hold money to do something for you. And anytime something or somebody does something for you that helps you, that doesn't mean you have to do it. That's usually a benefit.
Right.
I know why people used to not like them is because they were going into interest bearing accounts, which might happen right now. Interest is so high on bank accounts. I'm like, I don't want that escrow account,
Right.
but they've passed rules on that anyways. Like if an escrow company is holding your money, they usually have a non-interest bearing account. And if they do make interest, they give that back to you.
Right.
They're not allowed to make money on your money, basically, like every other bank in the world.
Don't get me started.
Don't get me started on banks.
Let's move over to the mortgage process itself. So we talked a little bit about mortgage. We talked about some of the jargon, principal, interest, taxes, insurance, HOA, interest rates, types of programs. But the process itself, I think we kind of went over it. Get pre-approved. It might be 6 months down the line, might be a year, it might be get that plan. So what's the entire process though once you are ready?
Well, the first thing I would say right now is I hate the word you just used. I take that back. I love the word you just used. I hate the other word that people use, which is pre-qualified.
Oh, pre-qualified.
Like those people throw that word around. They throw it around very loosely, the two words, right?
Oh, very loosely. And I think realtors have caught on. So a lot of loan officers will. So this is how the process works, right? You as a person buying a house will go to a realtor and they'll find you a house. This is $500,000. Go get it. Okay. And the realtor will tell this person, go get pre-approved by a lender or a bank. So they'll go to so-and-so and the loan officer will say, how much do you make? This is that. Okay. I'll write you a letter. And they just give them a piece of paper and the realtor runs off and, makes the offer and this and that. They're not pre-qualified. They're not pre-approved.
That is, I always mix it up. I don't even know right now. I'm off topic, but pre-qualified, everybody throws pre-qualified. And I want to be pre-approved. I want to actually approval from an underwriter that says I am credit approved, credit qualified, right? I could be using it backwards, but to me, like, again, people used to say you're pre-qualified. It's kind of like a sidestep of saying you're not really approved or qualified, or maybe it's pre-approved. Oh my gosh, it's going to rack my brain right now. Whichever one it is, you want to make sure that when you say you're pre-approved, you have actually had somebody look at your income documents, look at your financial situation, and make sure you really are approved. Because there are certain things that are going to be contingent upon that approval, right? Like what house do you end up buying? Are the taxes different or the HOA different? Those can affect you, right? Not to say they won't, but don't say, I make $5,000 a month. Okay, cool. You qualify for this amount. And then we get a pay stub and it says you make $4,000 a month. But now you get denied. And now you're discouraged. Real estate agent hates us and we don't get a loan to help you out. So
I would say pre-qualification is like me looking at a couple things and saying, yeah, you got it. Yeah.
Yeah. That's what a lot of people do. Like, especially cross, like realtors a lot of times have a relationship with another loan officer and they want you to cross qualify somebody. Right. And that person might be looking at just what you said, a really light overview. Actually, get a full underwritten approval. Like it's a credit approval is what they would call it, right? Because they're actually having to go to an underwriter who looks at your credit, looks at your income documentation and says you are approved. And here's what's needed after you find a house that you want to get.
But if you get those, you'll be approved. But you have that pre-approval from an actual underwriter, not somebody that just looks at a W-2. Great example of this would be somebody pre-qualified, but they won't get approved is they've only been working a year and a half. Somebody looks at their W-2 and pay stubs for the year.
Looks good.
But they don't have that prior pay stub from the year prior.
They don't have the history, right?
You're not approved.
Right. People will say, I got money in my bank or I'm getting, whatever, 50,000 in my bank. And then later you find out, well, no, it's my mom's bank, but she doesn't want to give it to me anymore. But what other options do I have? So, and by the way, getting that is not the end of the world. Like you can still if I pre-approve somebody and I go through the right way and do it, and then they don't like me and they're like, Jared's a loser. I hate him. He never calls me back. Go somewhere else. It's not the end of the world, but make sure you have done, like we talked about earlier, you're planning, you're getting a plan.
Right.
In fact, we actually, beginning of the year, and again, any time down the road, you're buying a house beginning of the year, have somebody approve you before you file your taxes because you can know if you have to make any adjustments to get what you're trying to do later that year is important. So yeah, pre-approval is just one step into home ownership.
Right. So, okay, let's say somebody gets pre-approved, gives that to the realtor, real estate agent is going around shopping houses, finds a good fit. Boom. They make the offer. What happens next?
They make an offer. They get a purchase agreement. Both parties sign that purchase agreement and they open escrow, which is the different type of escrow, title, right? They get the title and they get the escrow going basically, which is basically not to be confused with what we call like the escrow, right? For your taxes and insurance, escrow account, which is also called an impound account, right? So impound account, escrow account, same thing. We open escrow. That's the third party person that handles the money transaction. So we don't have to trust that I'm not just writing a check to the seller and they're going to give you the keys to the house, right? In the deed.
Right.
So yeah, so everybody agrees on it. You get a signed purchase contract, a residential purchase agreement, RPA, it's also called. And you open escrow, which means you will typically put down your earnest money deposit, the EMD, which is basically, I have a little skin in the game because I want to buy this house, whether it's 5,000, 1,000, 10,000, whatever you guys agree on. That's opening escrow. They're going to start looking at title or pull title and make sure there's nothing weird on there, right? Weird liens, solar liens, anything like that on there. And what's going to happen at that time is the real estate agent or you is also going to send the lender that purchase agreement. Right. So we can start getting all the ducks in a row and getting everything else that was needed. Like you're fully approved. And like I said before, here's what's needed to get to the next level. Okay, we got the purchase agreement. Now we can start finding out all the details and fine tuning those numbers. That'd be the next step, right? Everybody gets the purchase agreement and we go to work.
Right. So I think, what you said about the earnest money, that money down basically to show that you're interested and that I want this house. Let's put some money aside here to show you that I'm really interested in this house. Make sure you're pre-qualified. Make sure you're getting that approval at that point, because let's say you did all this pre-qual stuff and you weren't actually qualified and you get to that point. In a certain amount of days, you can lose that money, right? If you don't get that.
Yeah. That's all in the contract too. I mean, typically I think it's 17 days or 14 days, but people sometimes do 10 days. Sometimes when the market was hot, they would just like waive it. Like you have no way to get your money back if you don't want it. Better make sure you like it.
Look more attractive to the seller, right?
Yeah. I think the one thing too to note, like when you're talking with your agent and you're making offers and whatever the case is, nothing has to be done the exact same way. Everything's negotiable.
Right.
Like you can say, I don't want to have any kind of contingency period. Typically there's 2 contingency periods, the average, right? It's the get an appraisal done in this certain amount of time, right? Or you have to move forward or lose your deposit, and then get all the loan, all your financing signed off, contingencies removed so they know everything is good there and that you're moving forward. That's typically what they are, but you can waive those, you can extend those, you can shorten those, you can do whatever you want.
Right. So why would you want to get an appraisal when purchasing?
Aside from the fact that the lender is going to require it.
Okay.
I mean, the main thing is to make sure that you're getting the house at the right price, or you're aware that you're overpaying or getting a deal and underpaying on the house. So I could sell a house. You can sell a house for whatever somebody's willing to pay for it. I could have $100,000 house and I sell it for $1 million because some crazy guy down the street's willing to give me $100 for it. That house is worth $100 million to that guy, but it's not worth $100 million to that guy, but It's not worth $1 million to anybody else, because an appraisal is going to look at actual comps and what's in the area. So that appraisal is going to come back and say, this house is only worth $100,000. And he's going to be like, I don't care. I like that home. I'm willing to pay $1 million. So again, you get an appraisal so you know what the actual value is.
Actual value.
Yeah. And you can get appraised any time. And when you go through a lender, you have to go through certain channels of doing it, because laws that prevent your lender from actually ordering a direct, they have to go through a management company, basically a third party. So nobody can persuade anything for values.
Right.
But if you're selling your house, sometimes it's recommended to get an appraisal anyways, not through their lender, not pay that extra fee for it, but just go get an appraisal so you know what it's worth. But yeah, it's always to try to get what the market says your home is worth, not what you say your home is worth.
Right.
Now, you've had people that get an appraisal and it comes in $50,000 higher, and you're like, woohoo, you're walking into equity according to the market.
Right. What about an inspection?
Inspection is literally for your own reassurances. I mean, they walk through and tell you what needs to be fixed, what doesn't need to be fixed. And you can make the decision if you want the seller to fix those or give you a credit or
reduce
price. I mean, again, like everything's negotiable. So if I know that there's $10,000 of repairs that will pass financing and appraisal, but they're still there, I can ask for a $10,000 discount. I can ask for them to be fixed before we move forward. I could ask for a credit. So I pay the high price, but I get a credit to cover other costs or money in my pocket. So yeah, all these they're more tools that you get so you can negotiate better.
Right.
Or navigate better.
Yeah. I think it's important. Yeah. And just to know that I have these many days. I have someone to go look at the house to see if there's anything wrong with it. I want to get somebody in there to appraise it to make sure the value is there. Like those are all things. Don't just because you go under contract, don't be afraid that you're stuck in anything. You can always pull out within those timeframes, of course, but those are just like things to help you make sure that you're going to buy the house and you like it. There's nothing wrong with it.
These are rules, by the way, that we just are like the basics, right? Sometimes you don't need an appraisal. Sometimes you can get an appraisal waiver and not need an appraisal.
Right.
You might still want to get an appraisal just to make sure, but you don't need it. You don't always need a home inspection. I bought a house I never got an inspection on, or maybe two, and sometimes you do. So it just depends.
And it had termites.
Yeah, and then I had to rip it down and burn down. So, but yeah,
that'd be a fear, right? Somebody, right?
That's if I don't care and I'm willing to take the risk, then it doesn't matter. If I don't want to take the risk on losing a house for $300 inspection, whatever.
Well, okay. So all those things pass. Everything is good. Value came in good with the appraisal, this and that. All right. We're on our way to close this loan and buy the home. What's happening here at the end? We got all the documents in from the person who's buying.
Right. So you got the contract in, we order the appraisal. That's good. Your loan officer or processor, whoever's working on it, has told you what is needed. Those other conditions, you got everything in. Ideally, at this point, it goes back to the underwriter. If they sign off on everything at that point, the next step is going to docs. When people say go into docs, that means that they have basically signed off the underwriter of the file and they're fine tuning all the numbers and getting it over to the escrow company or title company to make sure they agree as well.
Right.
And there's things that change, by the way. So I don't want people to think like, you told me it was, $10,000. Now it's $10,200. No matter what, it is going to change because you don't know the exact day you're going to close. And one of the things that people don't understand is like daily interest. Like if I close this loan on the 1st, I'm going to pay a whole month of interest, prepay it, right? Or in my closing, if I'm buying a house, right? Because I'm not going to make a payment because interest from a mortgage is always in the past. It's in arrears for the previous month. But if I close on the last day of the month, I might pay 1 day of interest. And that, again, doesn't make any difference really in the large scale, but people don't understand that sometimes. So that's what I say when they say they fine tune it. Like, okay, we were trying to close on the 15th, but it looks like we're going to close early on the 13th. Let's add 2 days of interest in there, right? Or whatever the case is. So
that's always a tough one to explain, but yeah.
Yeah. So anyways, but that's what it is. So yeah. So your lender will send the documents, the final figures basically to the escrow title company. They'll balance it out, make sure it's all good. And if it is all good, they'll send all the documents that need to be signed to the title company and set up a notary appointment for you to either come into that escrow office. Again, we use escrow and title, kind of
both hand in hand
loosely here, depending on where you're at. But some places you do it with an attorney, right? So, and you can either go into that office and sign with them, or they can hire a mobile notary that'll come out to you wherever you're at and meet you to do it.
Meet you anywhere.
Yep, exactly. And you're getting close to the end. At that point, everything looks good. You've agreed on everything. You sign your documents.
Both parties are happy.
You might be closing and getting the keys that day or the next day, typically.
Right.
It can't go longer if they still needed conditions, but they went ahead and gave you the docs, but that's pretty rare these days. So that's it. You close. Congratulations. You're a new homeowner.
Right.
You typically won't have a payment for another month. Sometimes you'll be getting a tax bill if there's supplemental tax for the transfer, right? These are just things that you kind of prepare for afterwards, right? Like I'm not going to have a payment for 1 to 2 months, right? Because like I said, it's either prepaid interest.
It's already built into what you paid already.
Right.
Payment.
You might get a refund from your escrow if you overpaid, which is, I recommend to everybody, pay a few $100 extra. I'd rather you get money back than miss a day on closing because you didn't have enough money in there. Right. So yeah, I think you might get a little refund from escrow. You might get a tax bill for the transferring, supplemental taxes or whatnot. I think I have one on my desk right now. And that's about it.
So how long, from what we started with the contract, realtor found the house contract to that closing day, what typical is the time frame
I typically say it's between 15 to 30 days. There's, again, times are going to change. We've had times where it was taking 2 or 3 months to close a loan just because there's so much. It was bottlenecked and whatnot back in those days. But typically you should expect 15 to 30 days.
Right.
And again, maybe that seller doesn't want to move out for 40 days, right? So again, it's all negotiable.
Well, we've had situations like this and don't think you're stuck in that as well because the seller wants to sell the house too. I don't think they want to take advantage of any situation or anything, but the loan wasn't, finished. We needed some more documents, something changed. So we needed to take a little longer. The realtors work it out, the seller and the buyer work it out. you extend it a week, you extend it 2 weeks. So it can get extended, right? With no penalties or anything like that.
Right. Well, sometimes no penalties. It all depends. I mean, sometimes we're arguing with people, right? Like nobody knows the whole story. And if whoever your lender and your real estate are not good at communicating or transparent with each other, then there's going to be disagreements, stuff like that. So yeah, I mean, it's exactly what it is. It's an estimated closing date, and people think it's a final closing date. And I'm going to quit and sue you if it doesn't close, if it closes on or before or after that date. And that's not the case. It's an estimated close date. It might go longer. Maybe there's a problem with the appraisal. Maybe something needs to be fixed. Maybe you didn't get your documents in time. Maybe you still need more money or something like that. It's not happening. There's a lot of things that can happen like that. And there's a lot of good things. Maybe you thought you needed an appraisal and you don't.
Right.
Maybe you got everything and got signed off a week ahead, right? Like for us, we want to try to close or have our close, meaning ready to send docs out like a week before the estimated closing date. But it doesn't happen all the time,
right?
Because shit happens. So it comes up or whatever. So, but that's where we aim. So I think as long as you have a good team, like whoever your loan officer is, whoever your realtor is, they're communicating with each other and hopefully leaving you out of it for the most part, because you care about buying a house, not all the details too much, that you should have a pretty good.
Yeah. I'm glad you mentioned transparency. I think that's the best scenario for everybody, the buyer, agent, loan officer, and on both sides of, the agent on the seller side and the seller, have that little transparency communication between everybody. It makes it so much smoother and easier. If something comes up, it's a problem. All right, this is going to take an extra week. Fine, let's change the signing date, this and that. Easy peasy.
Right.
Yeah. So I think that's a huge thing to look at in these transactions. So
the next thing you do after that is you get all your power, utilities turned on, move your furniture in, have a housewarming party, and go buy another house.
There you go. What else do you want?
That's a wrap.
That's a wrap. Any closing thoughts and tips? Mortgage as a financial tool. How a mortgage can be a part of a larger financial strategy, not just a debt. I think we kind of went over that.
Yeah. I mean, I would think you have to know what the purpose is of what you're doing, right? Like if you're buying it,
what's your goal?
If you're buying it as a primary home, your first home, right? For example, let's just talk about that. Again, that is not an investment. We sometimes say it's the biggest investment of your life that you'll ever make. And it might be, but it's not really an investment. No financial planner is going to look at your primary home as an investment, because if all else fails, you still need shelter, right? So I don't like, even if they're like, what's your net worth? And let's look at all your assets. They don't look at your primary. So you shouldn't look at your primary either. And I think that's something to understand, is like, you're not making money on your primary usually. Now, if you're buying investment properties, you think differently, right? There's a different purpose for everything, or a second home, or an Airbnb, or whatever it is. So I think, knowing what your end goal is, know what your exit strategy is key to what you should be doing or what you should be getting. If I'm buying this house and I'm like, my plan, and not that it's going to stay that way, but my plan is to be here for 4 years and then upgrade to a new one because I want to get married and have kids or whatever. That's different than somebody who's like, this is my forever home, or I only plan to be here for 5 years and then I'm going to move to Nebraska and get a ranch, right? So knowing those things are important, because maybe I don't want to pay for a lower rate if I don't recoup it. Or maybe I do want to pay for the lowest rate I possibly get and be situated. Or maybe I want a short-term or a long-term loan or a different type of loan, right? Those are all things that can impact what you're trying to do. So if you know where you're going and you reverse engineer it, you probably will be able to structure it the right way to do it from the beginning.
Right. That makes sense. I like it.
Yeah. Tips. Don't wait till the last minute. Plan. That's a big one. Plan. Get pre-approved on buying something. Get your finances in order before you go shopping.
Right. That's what we found. It's kind of a power move when you're buying, because you're showing actual proof, not just a check mark saying you might be qualified. So
yeah, don't wait till the last minute either. Make sure there's plenty of time. Have a good plan.
Yeah. So I think we've covered most things here. Jargon, rates, types of mortgages. What is a mortgage?
Yeah, there's so much more. I mean, this is like basic, and we probably talked too much on some and not enough on others. So we'll find out if there's more that people want to hear about, or we can go deeper in, or even educate ourselves. I mean, been doing it for 20 plus years, and we've been doing it a long time, and there's still stuff that we learn all the time. So
those are the basics. I think that's what everybody should know, and just as a base.
We kind of skipped on jargon. I don't know if we want to go on that. I mean, we went over DTI and debt to income ratio.
Okay.
What
What's another jargon that people have to
or
talk
maybe we'll
about?
just put a link on it to the glossary on the website and
Loan to value,
LTV, loan to value. So today
That's a
we
big
talked
one.
about acronyms like ICE, income, credit, equity, the three things that qualify you. We talked about DTI, debt to income ratio. That's how your income qualifies you. Then we have LTV, which is loan to value. That is the equity position that you have on the house that you buy, right? How much you put down or how much it's worth and what you owe. Then you have CLTV, which is combined loan to value. That's if you have multiple loans, right? What those multiple debts against the equity is. Again, equity position. Then you have FHA. No, just joking. What else do we use?
Yeah, LTV is just, what you owe compared to what the house is worth, right? Loan to the value. So other than that, FHA, we talked about conventional. We talked about
PITI, principal, interest, tax, and insurance.
Talked about that. But yeah, your ICE is great. Yeah, I think that's an easy one to remember. I always joke because I'm like, you want to help somebody, you want a loan to go through, you want everything to work out. But it seems like of those three, income, credit, and the debt ratio or whatever, you're always missing something with somebody. Like no, like it's very rare to have everybody has a three.
Right.
It's always.
And when you have all three, that's called the A+ borrower, or prime borrower, right? But yeah, somebody could have like perfect credit, but they don't have any income to show. They're self-employed, or they got good income, but they're always maxed out. And these are common trends of people, by the way.
It's
so
stereotypical almost.
Yeah, exactly. I have a ton of money, but I have no
500
income.
credit.
Yeah, exactly.
No credit because they're borrowing everything and have a ton of money. But
yeah, exactly. So it's hard to find those all three, but those are, if you're trying to buy a house, you always want to make sure your income is where it needs to be to buy what you want to buy. The credit stays good and the equity is there. The down payment is there, right? For a down payment. Right. But again, it's not the end of the world. Like I said, those are not always the case. Like I have a ton of money. My credit's okay. Or let's say I make a ton of money. I have my own business, but my credit's shit and I have no way to show my income. Those are still loans you can do. Like we talked about, bank statement loans, private money loans. You can still have those. You can still find money. Like there's always a way to get money. But in that case, you put down a bigger down payment because it's a risk.
Right.
So they might say, put down 35, 40% down and I'll give you the money. I don't care about your credit.
Right.
And the one thing to note too, which is not important, I guess, on this one, but when we're talking like those DSCR loans or private money loans or hard money loans, those are loans that are based off of what you are buying, the asset itself, right? They're business type loans. Like if I were to buy a Foot Locker, it's not necessarily backed by what I qualify for. I don't know why Foot Locker, but it's based off what that asset produces, that business makes. And that's how those are calculated, right? That's why they don't care about your income or your credit, because I care about, does the business make money or does the house make money? Where the other loans, all the other loans are based off the person. What do they qualify for? What's their personal guarantee on this house?
Right.
So those are the two things that will kind of, if you want, again, going back to that common sense thinking, like I'll never qualify, even though I got a good business and I got a big bank account, my income and my credit sucks. Well, no, then you just put your money where your bad credit and income isn't.
Right. No, most people, there's a way somehow, typically. Some people, there's no way. Let's just face it. But
and then just give up on life.
But there's always a way usually. So that's why we always recommend asking a professional, look into it, look at somebody who knows all these programs, who can actually search for these programs. Or
when you say
them.
Professional, do you mean your neighbor or your brother-in-law?
No, somebody in mortgage, somebody like us.
Yes, exactly. Somebody, whoever it is, just don't ask. I typically would not ask family members and neighbors or friends unless they've been in the business a long time. Because again, everybody always tells me like, so-and-so told me this.
Right.
I don't care what so-and-so told you.
My friend's friend was a loan officer 3 years ago. He said to do this.
Yeah.
I just heard that 2 weeks ago. So yeah, I would ask somebody who's in the business, who's currently in the business.
Emphasize on that.
Yeah. So, but yeah, I think we covered a lot today. The basics, obviously, we can go over more into depth things later on, but yeah, that's kind of the overall overview of mortgage, kind of like terms wise, what it is, how it works. So let's wrap her up. And like always, we want to continue to come with more. So I think we decided we're changing our podcast
so we can be more focused on real estate and loans. And then, of course, our off topic, which is the stupid shit that we talk about.
Yeah, that's going to happen regardless. So,
but that'll probably change next week anyway.
Yeah.
So anyways, yeah, we always want feedback and we want to talk to more people and learn along the way, and then be able to pass off what we learned to others that don't know what that is. And that's why we're doing what we're doing right now. So,
all right.
Yeah, we'll come up with some more topics and get them out there for all 12 people to see.
All right. We'll see you soon.
See you soon.
Thanks, guys. Bye.